The beginning, what nobody saw. He was 26. Salary was average. Savings were limited. No rich parents. No inheritance. He had two choices: upgrade lifestyle or buy an asset. He chose the asset. While friends were posting vacations in Dubai and shopping trips in London, he was calculating mortgage payments. He put down $18,000. That money represented years of discipline. The duplex generated $320 per month after expenses. Most people would say, that's too small. But he was not buying income. He was buying control. Here is what he understood that most people miss. Real estate is not about rent. It is about leverage. Every month, the tenant paid the mortgage. The loan balance decreased. The property slowly appreciated. Someone else was building his equity. He was not getting rich fast. He was getting stronger quietly. 1 year later, the property value increased to $110,000. Not dramatic, but powerful, because now he had equity. And equity is fuel. Instead of celebrating small cash flow, he refinanced. Pulled out capital without selling. Used the bank's money again. Bought property number 2. Another average rental. Nothing flashy. Now 2 properties were paying down 2 loans. 2 assets appreciating. 2 income streams growing. This is where most people quit. Because it still looks ordinary. But ordinary repeated becomes extraordinary. By year 4, he owned 6 small rentals. Total portfolio value, $1.2 million. He was not a millionaire in cash. He was a millionaire in assets. Important difference. His monthly cash flow was now over $3,000. Not life-changing, but momentum-building. Here is the hidden shift. He was no longer trading time for money. He was accumulating equity. And equity compounds silently. Then something happened that changed the trajectory completely. He stopped thinking like a homeowner. He started thinking like a business owner. Single-family homes grow slowly. Apartment buildings scale faster. Because apartments are valued by income. Increase income. Increase value. This is where real wealth multiplies. He found a 12-unit apartment building. Price, $1.4 million. Most people would panic at that number. He did not. He analyzed the numbers. Rents were below market. Management was weak. Expenses were inflated. Opportunity was hidden. He partnered with one investor. Used bank financing. Closed the deal. Then he improved operations. Renovated units strategically. Raised rents gradually. Reduced waste. Improved tenant quality. Within 18 months, net operating income increased significantly. And because apartments are valued based on income, the building was now worth $2.1 million. Same building. Different management. $700,000 in created equity. Not saved. Created. That single move accelerated everything. If a property produces $100,000 in net income and the market values it at a 5% cap rate, the property is worth $2 million. Increase income to $140,000. At the same cap rate, value becomes $2.8 million. He did not wait for appreciation. He forced appreciation. That is the difference between investors and owners. With capital and confidence, he shifted again. He targeted Class A properties, modern finishes, prime locations, strong job markets, areas near financial districts in Miami, growth corridors in Dallas. Luxury tenants stay longer. Luxury areas appreciate stronger. Luxury properties attract institutional interest. He was no longer competing with beginners. He was operating at another level. Was it risky? Yes. Higher price points, larger loans, greater responsibility. But risk is reduced by knowledge. He never bought based on emotion. Only numbers. If the numbers did not work conservatively, he walked away. Discipline protected him. Patience positioned him. 9 years after the first duplex. Multiple apartment buildings. Portfolio value exceeding $12 million. Significant equity. Strong monthly cash flow. But here is the part nobody talks about. The first 4 years felt slow. Boring. Unimpressive. Wealth building is not exciting at the beginning. It becomes exciting later. Most people quit before the compounding effect begins. He delayed lifestyle upgrades. No luxury car in year 2. No penthouse rental. No showing off. Because cash flow bought assets. Assets bought more assets. Assets now buy lifestyle. Reverse the order and you stay broke. Start smaller than your ego wants. Focus on cash flow stability. Use leverage intelligently. Refinance strategically. Transition from small properties to scalable assets. Increase income to increase value. Delay gratification. Think in decades, not months. The luxury apartments were not the breakthrough. The duplex was. The peeling paint. The outdated kitchen. The unimpressive neighborhood. That decision required discipline. Luxury required scale. Scale required patience. The question is not whether luxury real estate is possible. The question is whether you are willing to look unimpressive in the beginning. Because wealth does not start glamorous. It starts strategic. One small rental. One disciplined decision. One long-term vision. And that is how $95,000 became $12 million. There are two types of people watching this video. People who feel motivated. And people who will take action. If you are the second type, subscribe now. Because every week we break down how ordinary people build extraordinary portfolios. Comment, assets over lifestyle, if you're choosing wealth over ego.